Okay, so let's start. We want to start our revision. We want to start our revision. And the first topic we want to revise is called impairment of assets. That's the first topic we want to revise. So before we do the question, or before we do a question on this topic, let me review the topic a little so that when we are doing the question, you will be able to remember what you know concerning impairment of assets. So let me review the topic first. Now, as a company, you may want to know whether your assets have suffered any impairment loss. As a company, you may want to know whether your assets have suffered any impairment loss. So to know whether your assets have suffered any impairment loss, you are required to compare the carrying amount of that asset. You compare the carrying amount of the asset with what we call the recoverable amount of that asset. You compare the carrying amount of your assets with an amount we call recoverable amount. Assuming the carrying amount of your asset is 1 million, and when you calculate the recoverable amount of that asset, you find that the recoverable amount of the asset is 800,000. Now listen, an asset is said to have suffered. An asset is said to have suffered an impairment loss if the carrying amount of the asset, is higher than its recoverable amount. That is the condition. That an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. So in this case then, you can conclude by saying the asset has suffered an impairment loss of how much? 200,000. Good. Now we continue. Now listen. What is the carrying amount of an asset? Of course, the carrying amount of an asset is the amount at which that asset appears in the books. The amount at which an asset appears in the books, that amount is what we call the carrying amount. In other words, it is simple. The net book value of your asset is what we call the carrying amount. Now, what is recoverable amount? To get the recoverable amount of an asset, we normally compare two values. For that particular asset, listen, for that particular asset, you are required to compare two values for that particular asset. One value that you will have to calculate is what we call the net realizable value for that asset. You calculate for that particular asset, how much is the net realizable value. Then you compute another value, which we normally call value in use of that asset. Now, so for that particular one asset, you have those two values. Now, whichever of the two amounts is higher, that is what you consider to be the recoverable amount. So for that particular asset, having calculated, let us assume that you computed the net realizable value and you got it as 700,000. And when you computed the value in use, you got it as 800,000. So when you compared those two, whichever of the two is higher, that is what you consider to be the recoverable amount, which in our case now, we are taking it to be 800,000. So when you are asked to define what is recoverable amount of an asset, we normally define recoverable amount of an asset to be the amount that is considered to be the higher of. Recoverable amount of an asset is the amount that is considered to be the higher of Number one, net realizable value, and number two, value in use. Whichever of the two is higher, that's what you consider to be the recoverable amount. The other question is, how do you determine the net realizable value of an asset? How do you determine the net realizable value of an asset? I hope you still remember that to get the net realizable value of an asset, you're supposed to take the selling price of that asset, and you minus what we call cost to sell. You normally take the selling price, or what you call the fair value, or what we call the market value of the asset, and you minus any cost to sell. That's how we determine the net realizable value. In fact, some books call this amount fair value less cost to sell. Instead of calling it a net realizable value, they just call it fair value less cost to sell. Fair value is the same as market value, the same as the selling price. Good. So that's how we normally determine the net realizable value. The second amount is what we call the value in use. Now listen. How do you determine the value in use of a particular asset? Now listen. To get the value in use of an asset, let us assume that you are determining your impairment by end of this year. So you will ask yourself, how much is the value in use of that asset as at the end of this year? To get the value in use of an asset, I do hope you remember, we normally get what we call the present value of all the estimated future cash flows. From the use of that machine, let us assume it's a machine, there are some cash flows that will be generated in the future. 2 years from now, 1 year from now, 3 years from now, how much will be the cash flows that will be generated from the continuous use of that asset? All those cash flows, if you get the present values of those cash flows, what you get now is what we call the value in use. So we normally define the value in use of an asset as being the present value, of all the estimated future cash flows that will be generated from the continuous use of that asset. Get the present values of all those cash flows. Now listen. IAS number 36, which covers this accounting standard. IAS number 36, now listen, identifies which components of the cash flows are these that should be discounted. Yes, you as a company, you try and project the future cash flows. But which are these cash flows that you are required to project so that you get their present values? There are three components of the cash flows that should be discounted in the determination of the value in use. One of the cash flows that you are required to discount is what we call any cash inflows that will be generated, any cash inflow that will be generated from the continuous use of the asset. As you'll be using the asset in the future, how much are the cash inflows that will be generated from the continuous use of that asset? That's one of the components of the cash flows to be discounted. Number two, let us assume that that machine, you project it to last for the next 5, 6, 7 years. But as a company, you project that somewhere maybe in the third year, we as a company, we shall need to spend some money for maintenance or repairs of that machine. We are projecting that the machine 3 years from now, 4 years from now, will require some maintenance. So we shall spend some money for the maintenance of that machine so that it can generate more inflows in the future. That cash outflow, So we are saying any cash outflow, this is cash outflow that will be incurred, any cash outflow that will be incurred or is considered necessary to be incurred to help the company to generate more future cash flows, that is another component of the cash flows that should be discounted. Any cash outflow necessarily incurred in order to generate future cash inflows. I've given an example. Maybe it's the machine, and 2-3 years from now, we project that we shall spend some money for maintenance or repairs of that machine. So that's another component of the cash flow that should be discounted in the determination of the value in use. Number 3, you all know that at the end of the useful life of an asset, that asset has to be disposed. So on disposal of that asset, it could be that you will sell that asset, and as a company you will receive some cash at the end of the useful life of that asset. In some cases, whenever you are disposing an asset, it may be that you as a company, you are the one going to spend money, not to receive. Maybe it's a machine that requires that you have to dismantle it for it to be disposed. And therefore, in the process of dismantling it so that you dispose it, you may incur some cost. So, the last component of the cash flow that should be discounted is any cash inflow or outflow. Any cash inflow or outflow that will be either received or paid at the end of the useful life of the asset due to the disposal of the asset. As a result of disposing that asset, are you going to receive cash or are you going to incur or spend some cash? Whichever. That's another component of the cash flows that should be discounted. So now listen. So I've reminded you in an overview how to test for impairment of an asset. We have said to know whether an asset has suffered an impairment loss or not, you compare the carrying amount of your asset with its recoverable amount. What's recoverable amount? It is the amount that is considered to be the higher of 1, net realizable value, 2, value in use. How do you get net realizable value? You take the selling price of the asset and you minus any cost to sell. How do you get value in use? We have said you get the present value of all the estimated future cash flows. Good. So I want us to do an example now. I want us to do an example in relation to this information that I've given you. Now, the question I want us to do is not a past paper question, because for the normal class, during the normal class, we did a question from the past paper which tested you on that concept. The one I want us to do is not a past paper question, but it is better than what we did in the normal class, because it has a small challenge that we shall see, which was not in the normal block release class. So let me project the question. I've already shared it in the group. So that is it. But let me project it so that we read it together now. Okay. It says, number A, the objective of IS number 36, impairment of assets, is to prescribe the procedure that an entity applies to ensure that its assets are not impaired. Required. Explain what is meant by an impairment review. Your answer should include reference to assets that may form a cash generating unit. Note, you are not required to describe the indicators of impairment and how impairment loss are allocated against the assets. Okay, that's a theory question. We shall answer it later. Because there are some things I've not reminded you there. But of course, the first part is obvious now. The first part that says, briefly explain what is meant by impairment review. Of course, impairment review now is what? It is the process of doing what? Of determining whether an asset has suffered an impairment loss. How do you carry out that process? To know whether an asset has suffered an impairment loss or not, we have said you do what? You compare the carrying amount of the asset with its recoverable amount. Then you can tell the examiner an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. Good. That's what you are saying is the impairment review. The process of determining whether an asset has suffered an impairment loss or not by comparing the carrying amount with its recoverable. Of course, you can tell the examiner how to get the recoverable amount. It is the amount that is considered to be the higher of net realizable value and value in use, blah, 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 whatever it is. That is it. For the other part of the question, I have not talked about it for now. The question is going on to say your reference should include reference to assets that may form a cash generating unit. I'll remind you first what's a cash generating unit and whatever. Then the other part also says you are not required to describe how or the indicators of impairment. We shall discuss that later. Okay, don't panic. That one we can do it later. Number B1 says, let me now do that. That's the one I want us to do. Number B1 says, Telpath acquired an item of plant at a cost of 800,000 on 1st April 2010 that is used to produce and package pharmaceuticals. The plant has an estimated residual value of 50,000 and it is estimated and it's an estimated life of 5 years, neither of which has changed. Telpath uses straight line depreciation. On 31st of March 2012, Telpath was informed by a major customer who buys products produced by the plant that it would no longer be placing orders with Telpath. Even before this information was known, Telpath had been having difficulty finding work for this plant. It now estimates that net cash inflows and from the plant for the next 3 years will be by end of 31st March 2013. Don't forget, we are testing the impairment by 31st March 2012. Get the point now? This machine or this plant was bought when? By 1st April 2010. Apogee by 1st April 2010. That time when we bought it, it had an estimated useful life of how many years? 5. 2012, we received an information that makes us to feel we need to test for impairment. So, now listen. 2010 being the year we bought on 1st April, it looks like the year ends in March. So the first year will go on from April 2010, it went on until 31st March 2011. The second year went on from 31st March 2011 to 31st March 2012. So we are testing for impairment. Listen, we are testing for impairment after 2 years. That's why the examiner is giving you down there in the table how much are the projected cash flows for the remaining 3 years. Why? Because the plant had a useful life of 5 years. Good. Now we can continue. We are told that we are projecting that we shall receive 220 by end of 31st March 2013, 2014, 180, 2015, 170. Next paragraph. On 31st March 2015, that's on the day of the last day of the year, of the 5 years. It says, on 31st March 2015, the plant is still expected to be sold for its estimated realizable value. Telpath has confirmed that there is no market in which to sell the plant as at 31st of March 2012. Telpath cost of capital is 10%, and the following values should be used. You are given value of 1 shilling 1 year from now, 0.9, 2 years from now, 0.83, and 3 years from now, 0.7. Those are the factors, the discounting factors, of course. Number B2, let me roll it fast. We read it. Number B2 says, Telpath owned 100% subsidiary, Tilda, that is treated as a cash-generating unit. On 31st of March 2012, there was an industrial explosion, an industrial accident, a gas explosion that, let me roll up, that caused damage to some of Tilda's plant. The assets of Tilda immediately before the accident were, you're given goodwill, patent, building, plant, cash. Then you're told, as a result of the accident, the recoverable amount of Tilda was or is 6.7 million. Next. The explosion destroyed to the point of no further use an item of plant that had a carrying amount of 500,000. Tilda has an open offer from a competitor of shillings 1 million for its patent. The cash is already stated at its fair value, less cost to sell, net realizable value required. Calculate the carrying amount of the assets in 1 and 2 above as at 31st of March 2012, applying any impairment losses. So part B has 2 parts. That's part A and part B. Part number A, listen, part number A, they are testing for impairment of an individual asset. That was the plant. Part B, they are testing on impairment of a cash-generating unit. I've not talked about how to impair a cash-generating unit, but I do hope that now that we are revising, at least you have some ideas. So before we do part B of the question, let's do part B1. But now, before I do it, I want to explain a few things concerning it. Listen. I've already told you we acquired that plant on 1st April 2010, don't write? Come 31st March 2012, we want to test for impairment of that asset. On 1st April 2010, we bought the machine for 800,000. Listen. It has a useful life that time, we are told, of 5 years with a residual value. That's what the question told us, with a residual value of how much? Let me check from that part A or part 1. B1 says, with a good second line, the plant has an estimated residual value of 50,000. Good. So the residual value here is 50,000. Now listen. We are not testing for impairment in 2010. We are testing for impairment in 2012. So what this question wanted you to do first, listen. They wanted you to calculate what is the carrying amount of the plant as at 31st of March 2012. I am given the value of the plant on 1st April 2010, but I'm not testing my plant on 1st April 2010. I'm testing the impairment on 31st March 2012. So the examiner wanted you to determine the net book value as at 31st of March. Meaning, take this cost of the asset, which is 800, you minus obvious the accumulated depreciation of that plant. For how many years? 2 years. I told you, we bought it in April 2010. That year went on until 31st March 2011. From there, it went on, the other year went on until 31st March 2012. Those are 2 years. So for 2 years, we have been using the asset. We need to depreciate it for those 2 years. We are told that the company decided to be using straight line method. That's what we were told. I can see it there. They are saying with an estimated life of 5 years, neither of which has changed. Telpath uses straight line depreciation. Good. So everybody knows how to compute. The cost is 800. You minus what we call the accumulated depreciation. Then once you minus the accumulated, you get the net book value. Good. So let's put down that now. Let's put down that. So maybe you can just see here, just right there, handout illustration, handout illustration, handout illustration, handout illustration. Then you come and say determination. Let's put it down. Determination. Sorry. Determination of the depreciation charge per annum. How much were they charging as depreciation per annum? So you can say this. Depreciation charge per annum is equals to cost minus, I hope you still remember your accounting. We normally take cost minus what you call residual value. Then you normally divide that by what we call, this is residual value. You divide by what we call the useful life. Useful life. Good. Useful life. Obvious, some questions give you a percentage and they tell you 10% on cost, 20% on cost. Still straight line. But when they don't give you the percentage, you normally use the formula or straight line. And the formula is always you take the cost of the asset, you minus the residual value, you divide that by the useful life. So our cost of the asset was 800,000. We minus the residual value, which is 50. We divide that by the useful life, which is we were given 5 years. So this looks like 750,000. We divide that by 5 years. So what becomes the charge per annum? Let me take, I take 750 I divide that by 5. That means every year we are depreciating our asset by 150,000. Then we come and now use that 150 to get the accumulated. So you can say down there, accumulated depreciation for 2 years. Accumulated depreciation for 2 years. It will be 150,000 times 2 years. And that gives me 300,000. That gives us 300,000. Good. Then we come and now say net book value. It is obvious, it's cost minus accumulated depreciation. Cost minus accumulated depreciation. The cost is 800,000 minus 300,000. That gives me an amount of 500,000. Good. That's 500,000. So now we know the carrying amount of the plant. Now we know the carrying amount of the plant. We want to determine now what is the recoverable amount. Don't forget we said you compare the carrying amount of the asset with its recoverable amount. Now we know the carrying amount. So now we can determine the recoverable. Listen, I told you to get the recoverable amount, what do? We compare two values. One is the net realizable value of the asset, and 2, value in use. Now listen, you remember the question told us that they could not get somebody to buy the machine or the plant. Where was that information given to us? Yes, after the table below there, after the table, you can see after the tables of the cash flow, they have told us on 31st March 2015, the plant is expected to be sold for its estimated realizable value. Telpath has confirmed that there is no market in which to sell the plant as of 31st of March 2012. So it means because they can't sell the plant, it has no net realizable value. So we are only left to calculate what we're calling the value in use. Then we assume the net realizable value is 0. We pick whichever of the two is higher. Good. Now let us compute what we are calling the value in use. So let us put down the workings. Andika somewhere determination of the value in use of the plant. Determination of the value in use of the plant. Determination of the value in use of the plant. Of course, we want to get the present values of those future cash flows. We want to get the present values of those future cash flows. And of course, to get the present values, you can do a table. You have a column for the year. You have a column of the cash flows. You have a column of the discounting factors. And you have a column of the present values. Good. So let's go to the table. By 1 year from now, 2 years from now, 3 years from now, what are we projecting to be the cash flows? They are telling us from that 1 year from now, which is ending on 31st March 2013, we project to generate a cash flow of 220. Good. So 2013, this is 2014, and by end of 2015, 2012, 2013, we are projecting to generate 220,000. Let me keep it in terms of thousands. Let me keep it in terms of thousands for now. Next, 2014. We are projecting how much? We are projecting 180,000. 2015, we are projecting how much? 170,000. Now listen carefully. There is an issue there in the final year. I want you to listen carefully. There is an issue there in the final year. Listen, as much as it's true, we are generating, or we shall generate 170. Remember, somewhere we were told, just below that table, that on 31st March 2015, the plant is expected to be sold for its estimated realizable value. When you look at the information above there, first line says towards the end, the plant has an estimated residual value of 50,000 and an estimated life of 5 years. So already we are told it has a residual value of 50,000. Get the point? I told you, listen, when you are determining the value in use of an asset, I reminded you which are these components of the cash flows that should be discounted. 1, any cash inflows that will be generated from the continuous use of the asset. That one we have been given. 2, any cash outflow that is necessarily incurred in order to generate future cash flows. This question did not have. Number 3, any cash received or paid. Any cash received or paid at the end of the useful life of the asset due to the disposal of the asset. So this question was tricky. Listen, in that final year, the examiner wanted to see, will you still use that 170 as the projected cash flow that year? The answer is no. Listen, the past paper question you were given, or we did in the normal class, the past paper question we did in the normal class did not have this concept in the final year. So whatever we were given, that's what we picked. But from this question now, we are realizing that in the final year 2015, over and above you regenerating 170 from the use of the plant, that same plant will be sold for its net realizable value, which is its residual value. So yes, you will generate from the machine, you will generate 170. But at the end of the year, it will be sold for another 50. That is the residual value. And that 50 is part of the components of the cash flows that should be discounted. So in that final year, the examiner wanted to see whether you will come and take that 170 plus the 50. Meaning now, in the final year, we expect a cash flow of 220. That was the trick in this part of the part 1B. Part B1, that was the only small trick, because the examiner wanted to see whether you will remember what are the components of the cash flows that should be discounted. We have said any cash inflow, those who were given 3 of them, any cash outflow necessarily incurred, nothing in this question. 3, any cash inflow or outflow that is either received or paid at the end of the useful life due to the disposal of the asset. We are disposing this asset. We shall generate another 50,000. So in the final year, there is 220 that should be discounted. Are you there? Good. Now we can get the discounting factors. Listen, this question has given us those discounting factors. There are questions that don't give you the discounting factors. But they just tell you the cost of capital is 10%, like in this question we are told, the cost of capital is 10%. If the examiner does not give you the discounting factors, having done finance, you should know how to compute that discounting factor. Of course, I hope you still remember, you get it by taking 1 plus r to the power of negative what? N. 1 plus r to the power of negative n. That's how you compute those discounting factors. Okay? So maybe I can test one, because I've already been given the factors. I don't need to calculate, but let us test one. We are told our R is 10% in the question, you remember? So if I take 1 plus R being 10%, it means we are taking 1.1 to the power of negative 1. 1.1 to the power of negative 1. That looks like 90, don't write 90 to the nearest 4 decimal places. Our company was giving us in 2 decimal places. How much? Down there, let me roll the question. Yes, the examiner gave us the discounting factor in the first year as 0.91, which is okay. It's the same as 90. So let me rub this and keep it to 2 decimal places. 90, 91, at 91, 091. The others I can now copy. That means we are getting the second one as 083. We don't have to prove it. The last one is 075. 075. Good. Now we can get the present values of those future cash flows. So let me take 220, multiply that by 091. So that gives me an amount of 200.2. 200.2. Okay. Next one, I take that 180, multiply by 83, 083. I'm getting 149.4. 149.4. Then I do the last one. Instead of discounting them one by one, I just discount to 20 because the factor is the same. So let me take 220, multiply that by 0.75, and that gives me 165. Then I get the total now, and that is the value we are calling value in use. That's what we are calling value in use. And so let me add all those. It will be 200.2 plus 149.4 plus 165. That gives me 514.6. That becomes the value in use. That becomes the value in use. Good. Now we can continue. I told you that there was no net realizable value. Why? Because they couldn't get somebody to sell to. Okay? So let's put down another point down there after you are through with the copying. Remember, we are trying to compute the recoverable amount by comparing 2 values. The net realizable value and the value in use. We have computed the value in use. Of course, I've just told you this machine could not get a buyer, so there was no net realizable value. So after you're through with the copying, put down this information. After you're through with the copying, put down this information. Say this. Since the plant does not have a net realizable value, since the plant does not have a net realizable value, then its value in use, shillings 514,600, its value in use 514,600. Don't forget, we were just putting our figures in thousands, but now we are putting it in full. because the other figures we did it in full. So the value, therefore, we have said, since the plant has no net realizable value, comma, then its value in use of shillings 514,600 becomes the recoverable amount, becomes the recoverable amount of the plant, becomes the recoverable amount of the plant, becomes the recoverable amount of the plant. Therefore, its value in use of 514,600 becomes the recoverable amount of the plant. Good. Then from there, now listen, we were told by part 1 to test whether the asset has suffered. Now listen. So I want you to tell me, from your conclusion now, has this plant suffered? From what we have done so far. Now we know the carrying amount. Now we know the recoverable amount. So I want you to chat and tell me whether the plant has suffered or not. I just want to know yes or no. From what we have done so far, has this plant suffered? It is either yes or you tell me no. Chat on the screen, on your chat, and you tell me whether it has suffered. Have you concluded? What have you concluded as to whether this plant has suffered an impairment loss or not? Has it suffered? Somebody says no. What about the opinion of somebody else? Somebody says no. Somebody has to give me an opinion. No. Good. Let me rely on those. Good. Now, listen. We have already said, what is the carrying amount? The carrying amount here was 500. There is that condition that says an asset is said to have suffered if the carrying amount of the asset is higher than its recoverable amount. So the carrying amount being 500, the recoverable amount being 514,600, then it's obvious the plant has not suffered. So I want you to put down something like this. Sema hivi, comparing the carrying amount of the plant, comparing the carrying amount of the plant, shillings 500,000, comparing the carrying amount of the plant, shillings 500,000, with its recoverable amount, shillings 514,600, shillings 514,600, comma, the plant has not suffered. The plant has not suffered any impairment loss. The plant has not suffered any impairment loss. Good. So that's all for part B1, because that's the question we were answering. We are answering, this is part B1. I even forgot to indicate it. Part B1. That's the part we were answering. B1. Now we want to do part B2. And part B2 is about testing for impairment of what we call a cash generating unit. Before we do the question again, let me remind you of some key concepts concerning that area of a cash generating unit. Listen. As a company, let's assume you are a company and you have an asset called A. That asset has a carrying amount, let us assume, of 200 million. You as a company, you want to know, could this asset have suffered? Could this asset have suffered any impairment loss? That's what you want to know. So you are supposed to compare this carrying amount of the asset with an amount called recoverable amount. You are supposed to compare the carrying amount with the recoverable amount. Good. Now listen. We know the carrying amount is 200. To get the recoverable amount, I already told you, you compare two values, net realizable value and another value we were calling value in use. Value in use. Now listen. To get the value in use of that asset, we said you do what? You get the present values of what? Of all the future cash flows. Somebody is asking a question. Let me find out. It has not suffered and yet no buyer. Oh, you are just answering. Thank you. And no buyer could have led to this. Sounds like obsolescence. Okay, so you are answering the question by saying it has not suffered. That's okay. True, it has not suffered. Let's continue. Now, I was saying this. You want to calculate the recoverable amount of this asset. You compare the net realizable value and the value in use. I've already told you, to get the value in use, we normally get the present value of all the future cash flows that will be generated from the continuous use of this asset. Now listen. Suppose this asset cannot generate cash flows. On its own, it has no cash flows. It cannot generate cash flows. How then do you calculate the value in use of that asset? If it can't generate its own independent cash flows, then automatically you cannot compute its value in use. And if you can't get the value in use, then you can't get the recoverable amount. Yet you as a company, you still want to know whether your asset A has suffered. What do you do as a company? When one of your assets on its own, it cannot generate its own independent cash flows, and yet you want to know whether it has suffered an impairment loss or not. How do you go about testing it? That's what I want to talk about now. So what as a company you will do is this. You will ask yourself, as a company, if as a company I put this asset A in a group of another asset, let me say I group it together with another asset B, which could be also be having a carrying amount of 200. I ask myself, now listen, as a group of assets, as a group of those two assets, can they generate their own, as a group, can they generate their own independent cash flows? I realize maybe no. Even if I put the two in one group, then I ask myself, what if I add to the group another asset? Let us assume asset C, which could be having a carrying amount of 100 million. Maybe if I put asset A, C into the group, now I realize that now as a group of those three assets, those three assets as a group, now they can generate their own independent cash flow. As a group, that group of assets can generate its own independent cash flows. So that group of assets is what we call a cash generating unit. It's what we call a cash generating unit. Remember, you as a company, you want to know whether asset A suffered. You are not after B, you are not after C. You are after knowing whether A has suffered. But you realize it could not generate its own cash flows. So you had to identify, you had to identify the smallest group, whereby if I put asset A in that group of assets now can generate cash flows. I am not saying put asset A together with all the other assets of the company. No. You are required to identify the smallest group of identifiable assets, which as a group of assets, now it can generate its own independent cash flows. That group of assets is what we call a cash generating unit. So if you are asked to define what's a cash generating unit, because sometimes you're asked, we are saying a cash generating unit is the smallest group of identifiable assets. A could be a machinery, B could be motor vehicle, C could be furniture. Those are identifiable assets. So a cash generating unit is the smallest group of identifiable assets, which on its own, it can generate independent cash flows. Now, once you now create this unit, now calculate the carrying amount of the unit, which is 200 for A, 200 for B, 100 for C. So your unit now has a carrying amount of 500. Then you compute the recoverable amount of the unit as usual. Compare the net realizable value of the unit with the value in use of the unit, because now you can calculate the recoverable. Let me assume that you computed the recoverable amount and you got it as 350. Then you ask yourself, has the unit suffered? The answer is yes. The carrying amount is higher than its recoverable amount. So the unit has suffered an impairment loss of how much? 150,000 or million, whichever the amount. Good. Now the question is, how do you allocate this 150 to the assets in the unit, The accounting standard says that if a cash generating unit suffers an impairment loss, that impairment loss should be allocated. It should be allocated to the assets in the unit on the basis of their carrying amount. Meaning, against asset A, which had a carrying amount of 200, divide by the total of 500, multiply that by 150. So out of 150, that is the proportion you write off against asset A. B has another carrying amount of 200, divide by 500, multiply that by 150. That will give you the amount write off against B. Against C, which had a carrying amount of 100, divide by 500, multiply that by 150, that will give you the amount write off against asset C. Okay? Good. So that's how you allocate the impairment loss of a cash, or to the assets in a cash generating unit. Now listen to another key point. Suppose one of these assets in the unit, let us assume asset C is an asset called goodwill. Suppose a cash generating unit has a goodwill element in it as an asset. Still you calculated the recoverable amount and the carrying amount, correct. And you still realized that that unit has suffered a loss of 150. The question is this now. Will you allocate this loss of 150 to the assets in the unit the way we allocated the earlier way? The answer is no. Now listen. So the accounting standard goes on to say that if a cash generating unit to which goodwill belongs, if a cash generating unit to which goodwill belongs suffers an impairment loss, if a cash generating unit to which goodwill belongs suffers an impairment loss, then that impairment loss should be written off. That impairment loss should be written off in a particular order. That impairment loss should be written off in a particular order. Listen, what is that order? You are now required to first write off any carrying amount of the goodwill. You cannot say the unit has suffered and then still keep goodwill in that unit. No. You first eliminate or write off the carrying amount of that goodwill. Meaning, out of 150 total impairment, write off that 100, write off that 100 that was for goodwill. This will leave you with a balance of 50 million. This 50 million now, listen, it is the one now you allocate to the other assets. How many are the other remaining? 2. That is A and B. And you allocate this 50 to the other assets on the basis again of their carrying amount. A had a carrying amount of 200. B had a carrying amount of 200. So against A, it will be 200. Now you don't divide by 500 because you have already eliminated C. You now remaining with 2, which have a carrying amount of 400. A 200, B 200. Total 400. Multiply that by 50. For B, again it will be 200. Divide by 400 times that 50. That's how you allocate. That's how you allocate the impairment loss to the assets to the assets of the unit in which goodwill belongs. First, write off the carrying amount of any goodwill. Then the balance of the impairment loss should be written off against the other assets in the unit on the basis of their carrying amount. Don't you think so far? Now I have answered the theory part of number 1. Don't you think I've now answered the theory part of number 1? Now you should be comfortable to answer that question. It says, explain what is meant by impairment review. That one we have already said. Your answer should include reference to assets that may form a cash generating unit. The other part they have told you, do not describe indicators. But part 1 of that question says your reference should include assets to a cash generating unit. Though the part B or the other note said, do not also indicate how impairment loss are allocated to the assets, I've already answered that one. Because it could have been asked that describe how we test impairment loss of a cash generating unit and explain how impairment loss are allocated. This one told you not to allocate. So that part A wanted you to know, first you should have told the examiner what is a cash generating unit. That it is a cash generating unit, it is the smallest group of identifiable assets. which can generate cash flows, which can generate their own independent cash flows. That is a cash generating unit. It is the smallest group of identifiable assets which can generate their own independent cash flows. Then again, you would have still gone on and said, how do you test for impairment loss of a cash generating unit? Because you are also told to show the reference. You say, if a cash generating unit, if the carrying amount of the cash generating unit is higher than its recoverable amount, then the unit is said to have suffered. That's what you do. Of course, they have not asked you to explain how to allocate, but I've already told you that in case a unit suffers, in case a cash generating unit suffers an impairment loss, I've told you that impairment loss should be allocated to the assets in the unit on the basis of their carrying amount against A, B, and C. And if the examiner was asking you, could also go further and say, if a cash generating unit to which goodwill belongs, if a cash generating unit to which goodwill belongs suffers an impairment loss, then I've said that impairment loss should be written off in a particular order. We have said number one, write off, or you eliminate the carrying amount of any goodwill. Then I've said the balance of the impairment loss should be allocated to the other assets in the unit on the basis of their carrying amount. On the basis of their carrying amount. Good. So that is it for that introduction. So now you know the concept behind a cash generating unit. Now, part B of the question, I may not be able to do it now because I just wanted to introduce the blocks for today, but let us just read part B because it has some challenge. Part B2, it has some challenge that I'll talk about next time. It has a challenge. Let us just read it, then I'll talk about it later. It says, Telpath owns 100% subsidiary. Tilda Limited is treated as a cash generating unit. On 31st of March 2012, there was an industrial accident, a gas explosion that destroyed or that caused damage to some of the Tilda's plant. The assets of Tilda immediately before the accident were, you are given. Then you are told, as a result of the accident, that's what the question says, as a result of the accident, the recoverable amount of Tilda is 6.7. So this time, listen, this time you have been given the recoverable amount. You don't have to calculate it like we have done in the first case. It's already given. You don't get the present values, you don't get the net realizable value, so that you compare the two. That is already given. Then they are saying the explosion destroyed to the point of no further use an item of plant that had a carrying amount of 500,000. Tilda has an open offer from a competitor for shillings 1 million for its patent. The cash is already stated at its fair value less cost to sell, net realizable value. Now, listen. We did a similar question in the normal class. I think it was November 2020 question, except that one, listen, except that one did not have a lot of issues like this. This has two issues. The other one had only tested you on one issue. Here, we are told there was an accident, a gas explosion that destroyed a plant, which is one of the components you can see of the cash generating unit. It only destroyed one component of the unit. That was the plant. Okay? Which is part of the unit you can see in that list. The second last one is a plant. We are told by the paragraph below it, the explosion destroyed to the point of no further use an item of plant which had a carrying amount of 500. Meaning, for that particular plant that was destroyed, the 500 one, can you still test for impairment for it? Remember, it was destroyed beyond any further use. And we are asking, shall we still test it together with the other plant? The answer is no. That which has been destroyed beyond further use means it's no longer an asset. And you cannot test for impairment of something that's no longer an asset. An asset, by definition in accounting, we normally define an asset as an economic resource or a resource from which you as a business, you are expecting to generate economic benefit. An asset normally is a resource from which you expect economic benefit. So if this plant has been destroyed beyond further use, then it's no longer an asset because it doesn't meet the definition of an asset. So what do? That was one of the challenge. That same challenge was tested in the paper of November 2020 that we did in the normal class. But then another challenge is here. If you look at the table, we have an asset called patent, which has a carrying amount, you can see in the list there, 1.2 million. But this question goes further to say, the paragraph below that table says, second line, Tilda has an open offer from a competitor of shillings 1 million for its patent. Meaning, we can sell that patent for at least 1 million. How does it affect our computation of the impairment loss and how we shall allocate that impairment loss? That's another factor that I'll talk about next time. So I have no time to finish because I have another class at 8. So for today, I just wanted to introduce. So in our next lesson, which I think will be, I don't know whether it's Saturday. I think it's Saturday, yes. We shall now finish the question. Then we review another topic. So maybe for today, we can stop there. We pick it up from there next time when we now finish part B of that question. I will do the calculations. It has those two challenges. The plant that was destroyed and the patent that we can recover 1 million shillings if we sell it. How does it affect our impairment loss computation? That's what I will discuss next time. Otherwise, we can stop there for today. We pick it up from there next time. Otherwise, have a good night. See you next time. Good night. We shall finish the question. Of course, you can still attempt it. See you next time. For those who never did the November 2020, you can also look at it. You can attempt it. Okay, bye. See you next time. Bye for now. Okay. Good night. Good night.